Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Today we will try to discuss the firm's capital structure or capital structure of a firm. So our today's topic is to discuss about capital structure. Now, what is capital structure? Actually, capital structure is the combinations of debt and equity, the mix of debt and equity of a company's capital. That is the capital structure. The capital structure is one of the most complex areas of financial decision making because of its interrelationship with other financial decision variables. Poor capital structure decision can result in a high cost of capital. Poor capital structure decisions can result in a high cost of capital, thereby lowering the NPVs of projects and making more of them unacceptable. On the other hand, effective capital structure decision can lower the cost of capital, resulting in higher NPVs and more acceptable projects, and thereby increasing the value of the firm. The sources of funds which may be used to finance a company's operations may be broadly classified as either debt or equity. The proportionate relationship between a company's debt and equity is referred to as its capital structure, or you can call the combinations of debt and equity used to finance a firm is called the capital structure. Then target capital structure, the mix of debt, preferred stock and common equity which the firm plans to finance its investment is the target capital structure. A firm establishes a target capital structure it believes is optimal, that it uses a guidance of for raising funds in future. So actually it is the guidance for raising funds in future. This target might change over time as conditions vary, but at any given moment of the firm's management has a specific capital structure in mind, and individual financing decisions should be consistent with this target. If the actual portion of debt is below the target level, new funds probably will be raised by issuing debt. Whereas if the proportion of debt is above the target, a stock probably will be sold to bring the firm back in line with the target ratio. That's why the capital structure policy involves a trade-off between risk and return. Using more debt raises the riskiness of the firm's earnings stream, but higher portion of debt generally leads to a higher expected rate of return. From the concept we discussed, we know that higher risks associated with the greater debt tends to lower the firm's stock price. At the same time, however, the higher expected rate of return makes the stock more attractive to investors, which in turn ultimately increases the stock's price. Therefore, the optimal capital structure is one that strikes a balance between risk and return to achieve the ultimate goal of maximizing the price of the stock. So here we will see the four primary factors influence capital structure decisions. So now we will try to discuss capital structure decisions. Capital structure decisions, our topic is now. A company's risk characteristics stem from two sources: business risks and financial risks. So business risks, which is that part of a company's risks inherent in its operating conditions, and financial risks, which is the part of a company's risks which result from use of debt in its capital structure. When a company introduces debt into its capital structure, it becomes a levered company. That means whenever a company uses debt, it is called the levered company. In this case, ordinary shareholders are exposed to increased variability in their returns, and the company to the increased possibility of bankruptcy. This results from contractual nature of interest payments and principals repayment on debt. Thus, a company's financial risk is directly related to the proportions of debt in its capital structure. So here is the matter, that's business risk, which is related to the operations of the firm, and every firm can bear this business risks. If it is used debt or not, business risks always time in a firm has. Greater the firm's business risks, the lower the amount of debt that is optimal. Second key factor, that is the firm's tax positions. A major reasons for using debt is that interest is tax deducible. Interest of debt is tax deducible, which lowers the effective cost of debt. However, if mass of a firm's income is already sheltered from taxes by accelerated depreciations or tax losses carryovers from previous years, its tax rate will be low and debt will not be as disadvantageous as it would be to a firm with a higher effective tax rate. The third important condition is that financial flexibility, where the ability to raise capital on reasonable terms under adverse conditions. Corporate treasurers know that a steady supply of capital is necessary for stable operations, which in turn are vital for long success. They also know that when money is tight in the economy, or when a firm is experiencing operating difficulties, a strong balance sheet is needed to obtain funds from suppliers of capital. Thus, it might be advantageous to issue equity to strengthen the firm's capital base and financial stability. The fourth determining factor has to do with managerial attitude with regard to borrowing. Some managers are more aggressive than others. Hence, some firms are more inclined to use debt in an effort to boost profits. These factors does not affect the optimal or value maximizing capital structure, but it does influence the target capital structure in an actual establishes. So here we will try to discuss. It is assumed that a company holds the compositions of its assets constant so that the company's business risks can be assumed to be constant. This enables us to concentrate on the company's financial risks. The effects of introducing debt into a company's capital structure has an effect on its earning per share. If we try to discuss an examples, then it will clear to us that the effects of debt of a company's capital structure has effect on earning per share of the common stockholders. Now let us see the example. So example is, consider two companies which are identical in every respect except ABC Limited company has no debt with 10 lakh fully paid up ordinary share capital, $1 per share, and XYZ has 50% debt and 50% equity. In order to show the increased variability of earnings available to ordinary shareholders and increased probability of bankruptcy where debt is introduced into the capital structure, it is assumed that there are no taxes and there is a decrease in earnings before interest and before from 2 lakh to 1 lakh and then 50,000 for both companies. What effect will this decrease in earnings have on earning per share available to ordinary shareholders in each company? We have to see what will happen EPS for of this both two companies. So here we will see ABC company has no debt with 10 lakh fully paid up ordinary share capital, $1 per share. That means it has a share of 10 lakh shares outstanding for ordinary shareholders, 10 lakh shareholders. So the effect should be have 10 lakh shareholders because it has the per share price is $1. On the other hand, XYZ has 50% debt and 50% equity. That means 5 lakh paid up ordinary share capital. So 50% of 10 lakh, that means 5 lakh ordinary share capital, that and 1 taka per share. That means XYZ company has the shareholders of 5 lakh. On the other hand, ABC company has shareholders of 10 lakh and it has another 5 lakh of debt comes from debt. So now we will try to see what will happen to the EPS, earning per share. So here is said there is no taxes. So tax has or no tax, that doesn't matter. If there should be tax, then it should be deduct from this from here is the earnings. From the earnings, tax should be deducted. So here only deducted interest from this 2 lakh, 1 lakh or 50,000 for the company XYZ. If there has the taxes for both company ABC should be deducted from 2 lakh, 1 lakh and 50,000 companies. And after that we will calculate earning per share. So we know that formula, earning per share equal to earnings available to the shareholders divided by number of outstanding share. We know the formula very well. Now let us see these examples. So here is the two companies, ABC Limited and XYZ companies, and we will see its capital structure. Here is the capital structure, 100% equity. This is its capital structure, and 50% equity and 50% debt. That is the capital structure of XYZ companies. So we will try to mark it that. So that is the 100% equity company, and this is 50% equity and 50% debt companies. So 50% debt, 50% debt. So these 50% debt, that means 5 lakh comes from the debenture, using debenture, and whose interest rate is 8% debenture, XYZ companies. Whereas it has 10 lakh ordinary shares, 1 taka per share, we know it, and share capital 10 lakh. XYZ company 50% equity, that means 5 lakh ordinary share, $1 per share, that means capital 5 lakh. On the other hand, debt 50%, it comes from 5 lakh from the debenture, 8% debenture. Then total share capital, total capital is 10 lakh. So these are the identical companies, except ABC is the equity firm and XYZ is the levered firm. We know that this is the levered firm. That means the company which is a use debt in its capital structure is called the levered, LEVERED, levered firm. So XYZ actually is the levered firm and ABC is the equity firm. We know it. Now our conditions is that the earning before interest and taxes, here has no tax. Earning before interest is 2 lakh, 1 lakh and 50,000. What will happen the ordinary shareholders earnings? We will try to see this. So for ABC Limited companies, total available earnings for shareholders is 2 lakh, because our earning before interest is 2 lakh. So EPS, what would be its EPS? Then if we calculate the EPS, then we will see earnings available to the shareholders divided by number of ordinary shares. Then so our result is 0.2, that means 20 cents. EPS is 20 cents. So it is clear that it is 20 cents. Our result is 20 cents. And if we try to see what will happen to the levered company XYZ, so total earnings is 2 lakh. So it is clear that total earnings is 2 lakh, but it has interest 8% debenture, 8% debenture. At first we have to calculate the interest. So 50 lakh 50 lakh, sorry 5 lakh, 5 lakh into 8%, 0.08, that means 40,000 taka interest it has to pay it first, because it is interest, it must be paid because it takes loan from the peoples or any other institutions. That's why it has to pay it 40,000 at first. So what will be happen the other earnings? Other earnings should be, if we calculate in here, it is clear that this is our earnings minus this is our interest. So 1,60,000 taka or a dollar which is available for the shareholders. So what will happen? Our EPS should see that this our earnings divided by our ordinary shares, number of ordinary shares, that means 32 cents. So the levered company's shareholders are getting more than unlevered company's shareholders. That means we can see that if the income is high, then the levered company's shareholders can get more return from their investment. So it is clear that whenever the income is 2 lakh, then the income of shareholders of unlevered companies is 20 cents, whereas levered companies earnings is 32 cents per share. So now we will see earnings for 1 lakh. If the earning is 1 lakh, what will happen? If the earning is 1 lakh, then what will happen to unlevered companies EPS? So it is clear that we will see earnings available to the shareholders, that is 1 lakh divided by number of outstanding shares. So we are seeing that 10 cents. So whenever earnings are down to 1 lakh, then unlevered companies earnings down to 10 cents. Now we will see what will happen to XYZ levered companies earnings. So at first this company will pay its interest, that is 40,000. Then what will happen to its available to its income? So it is clear that this is our income, 1 lakh minus interest paid, that is 60,000 taka available earnings for the shareholders. So what will happen to our EPS? So this is our earnings 60,000 divided by number of ordinary shares 5 lakh. So still is greater than the unlevered company, that is 12 cents. Earning per share is 12 cents. Now again we will try to see if earnings down to 50,000, what will happen to the company's income. So total available income available to the shareholders is 50,000. So EPS equal to 50,000 divided by number of outstanding share 10 lakh. So what will happen? 0.05 cent, that means 5 cents income available to the shareholders. So if the income down to 50,000, then still unlevered companies shareholders earnings are 5 cents. But what will happen to the levered companies? So at first it has to pay its interest, that is 40,000. It has to pay interest, and then what will happen? Our total income available to the shareholders. So this is our income minus interest, that is 10,000. So what will be our EPS? This is available income divided by number of outstanding shares, that is 2 cents. So in these positions we are saying that if the income down to 50,000, then unlevered company shareholders earnings more than the levered companies. So again if we will try to see that if this year has the zero earnings, that means zero earnings, that is there is zero, what will happen? It is saying that we will see that whenever income is zero, then our EPS should be 0. Our EPS should be 0. But this is unlevered company, earning available to 0, EPS also 0. But here is a problem. In the levered company has a problem, because there is no earnings, but it has to pay 40,000 as interest, has to pay, because that is the mandatory. So its income is negative. Its income is negative, totally negative income. So it comes to the loss. But unlevered company is not at loss, but it is income is 0, but it has to sell its property to pay its interest. So that is actually different techniques, whereas a levered company or unlevered company, if you have equity financing or debt financing. So in this way we can see the effect of leverage on its capital structure, levered company or unlevered companies calculations. In this way we can see. So it is clear that the earning per ordinary share will increase if the investment financed by debt issue is available to the generated return greater than the cost of debt, but will decrease if the return generated is less than the cost of debt. So here we will see if the company's earnings are more, then the EPS are more for the levered companies. The use of debt increase the financial risks faced by ordinary shareholders, with the result that their required rate of return is likely to increase greater the company's debt equity ratio. So the returns and risks as expected by a company's ordinary shareholders are likely to change. Therefore, as the company changes its capital structure, the use of more debt is not necessarily increase the shareholders. So lastly we are saying that the use of more debt is not necessarily in the interest of shareholders. So actually these are the effect of capital structure decisions on our earnings. Here we will use the two examples, two companies, identical companies. One is equity firm, another is lever firm. So in this way we can show the effect for our capital structure. So in this way we can prepare the capital structure decisions, what will be better for us, what will be the ratios. This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.